Sure.
Hello everyone,
This
welcome to the Crypto Traders Academy livestream. This is the 13th of July. We'll be going through my Smart Money Concepts Guide Part 1, identifying liquidity and understanding PD arrays, and also we'll be going through some live market analysis. So yeah, let's make a start now. More people will probably join in a bit. So first thing is just a little bit of a live market analysis before we move on to learning about smart money concepts. We just had the PPI released an hour ago. You can see that the producer price index came in lower than forecast, and unemployment claims came in lower than forecast as well. It's pretty similar to what we got yesterday with the CPI, so you can see that there's no really noticeable impact on the market so far. The New York session has just opened a few minutes ago, and what I'm looking at right now is this fair value gap zone, starting from 30,570 to 30,600. So for price to continue higher, we do need to see an inversion of this fair value gap, which is flipping it from resistance into support. You can see that on PPI release, we saw a wick downwards, which filled in the 15-minute fair value gap. So there is a reasonable chance that we can see this play out on Bitcoin. A few hours ago, I alerted a long position on Matic, and we can see that we got a pretty significant expansion quite quickly. Reached the first price target at 75 cents. And currently you can see that it is just consolidating a little bit. I'd say for continuation, the most it should retrace to is around the golden pocket zone at around 74 cents to 75 cents. So yeah, not too much going on right now, and we'll have a look at this again afterwards. So yeah, let's begin now with learning about smart money concepts. So I released my PDF guide in the education posts section, so do check it out if you haven't already. So smart money concepts mainly has to do with understanding the intentions and footprints of the market maker. Those are large institutional traders and big banks, which account for about 70% of the total trading volume. So you can see that it's not us retail traders moving the markets, but rather these big players, and they do have the power to move price as they desire, and usually they move price in such a way to eat up as much liquidity as possible. So stop losses, liquidation points of retail traders, those are what they're really looking for in moving the price action. So yeah, firstly, we'll just look at identifying liquidity, just sort of like being able to spot where all of these resting stop losses and liquidation points of retail traders are resting. And in doing so, we can anticipate any manipulation moves. So usually you can see that in a trending market, we have price action making multiple swings, swing lows and swing highs. So it looks something like this, right? For swing lows, we have a trough followed by two candles closing in the opposite direction, or just one candle. And on the left, we have also two higher lows. So that's a swing low, and vice versa for a swing high, where we have a peak reached before a decline. And commonly we have stop losses resting below swing low points or above swing high points. So you can see in this sort of scuffed trend drawing here, in a downtrend, swing lows and swing highs, and you can see there is a swing high right here. Right, so retail traders will see this trend and look to enter into a short position, and many might place their stop losses resting above this point here. the market maker can do here is push the price just a little bit above that swing high level, and then subsequently continue the downtrend. And in doing so, they will have stopped out multiple short positions, right, and eating up their liquidity. And yeah, pretty much in a nutshell, market makers counter trade these retail traders, and that's why the win rate or like profitability of retail traders are so low. Over 95% of traders lose money over the long term. So that's the sort of like trending scenario. We also have the sideways consolidation case where price is trading within a defined range, like in this picture right here. And obviously the retail trader will see this as a support zone, right? The bottom of the range and top of the range as the resistance zone. And obviously it makes sense, right, to short at resistance and long at support. So what market makers can do in this situation is push the price just a bit above the top range and also a bit below the lower range. And in doing so, traders who are looking to long support and stop loss below the range low will be stopped out and miss out on the subsequent move up. And same thing for shorters looking to short from the range highs. They'll be stopped out and then they'll miss out on the move towards the downside. So we sort of see how retail traders place their stop losses, right? So it's either a bit above swing highs or a bit below swing lows, or a bit above range highs or a bit below range lows. And what we can do is we can see how price reacts once it sweeps out one of those levels, and we can trade accordingly based on that. So this is buy side liquidity and this is sell side liquidity. That's the sort of phrasing we use here. Right, so what we've seen so far is we do need to think in the perspective of a retail trader. Think about how they place their stop losses and their liquidation points. So stop loss below support levels, so therefore equal lows, would also be a resting liquidity point. And you can see here price rigged below these equal lows. Right, so pretty much this is support level, rigs below, and then pushes price upwards. Another example here, swing low here, bottom of the trading range, price pushed slightly below, and then reversal upwards. And then here we have approximate equal highs, so established as a resistance level, and then price pushed a little bit above the swing high level and took out the buy side liquidity. Right, so let's have a look at like a few examples on the chart. So we can see that Bitcoin has been trading in like pretty tight range for a while now, and during these sort of trading ranges is when you can really see how often these stop hunts occur. Right, so you can see yesterday after the CPI release, we have the sort of swing low right here, and this was taken out, and then we saw a sort of reversal towards the upside. Right, same thing here, swing low, rigged below, and then reversal upwards. Same thing on the opposite end. So we have these resting highs here, price pushed slightly above, and then very large dump downwards. Right, so it's really not extremely difficult to identify like where some stop losses may be placed. The difficulty comes from like knowing where the most liquidity lies. Right? So one way of understanding that is trading based on a liquidity to liquidity concept. Right? So once sell side liquidity is taken out, the market makers will now seek to take out buy side liquidity. right? So kind of like what we're seeing, what we saw like right here with this swing low and these equal highs. Okay, so took out this swing low, pushed upwards, and then took out those swing highs and then pushed downwards. So liquidity to liquidity move when price is trading in a very tight range. Let's look at a few more examples. Right, so this is what we looked at before, a sort of consolidation range. So stop loss for buyers placed below support and stop loss for sellers above resistance. A sort of common price action pattern we see play out is the sort of power of three model, where the manipulation goes above the trading range and then distributes towards the downside, where we see a larger price expansion, and then vice versa for distribution upwards. So manipulation below the trading range and then subsequently pushed aggressively to the upside. Right, so this move here took out all of those long positions who sought to long at support, and then once those positions were taken out, we distribute much higher for the true move to the upside. Okay, so accumulation, manipulation, and distribution. A few rules for this sort of price action pattern is we want to see like a defined range. So that means like the lows have been tested at least 2 times, highs have been tested 2 times as well. Manipulation should not last very long, and expansion should be quite swift as well. Right, so if price is just continuing to chop sideways without breaking above the previous accumulation range, we can sort of then define that as reaccumulation. Let's have a look now at trendline liquidity. Right, a lot of retail traders do use trend lines to place their trades. So a sort of like common way of trading trend lines, right? Something like this. We have clearly uptrend and price bouncing multiple times from the trend line. So a few ways to trade that would be to long on a touch of a trend line, or upon a break of the trend line, shorting from the resistance point, right, which is support turned into resistance. So yeah, kind of like this, entry once this resistance has been tapped, and then other way around for trend line resistance. So upon breakout, retest of the trend line, expansion back up. That's a sort of like price action pattern that we expect using retail trading patterns. So how will the market makers counter trade that? Right, so they create the touch of the trend line, they expand a bit up, and suddenly they dump the price straight to the stop loss. Right, that's one scenario, and same thing other way around. So touch of the resistance trend line, little move down, and then suddenly push up to take out all of those stop losses. So we have a example from May the 6th, right? Breakout of this trend line, a small move upwards, and suddenly a dump downwards, taking out all of those breakout trades. So personally, the way I use trendline liquidity is to sort of identify where, like which direction the market makers will look to hunt next after like a sweep. So you can see in this example, we have a sweep of the lows followed by expansion towards the upside, and we have like this sort of trend line liquidity here that we can use as a price target. And same thing right here as well, a very clear trend line as resistance, and then the lows have been swept, got an expansion upwards, so the price pushes beyond the trend line to stop out the traders who are looking to short upon each touch of the trend line. And also note that the trend line doesn't have to be perfectly like as a line. It can be slightly curved, can just be connected like this. Right, it doesn't have to be perfect, but it pretty much just represents highs that has yet to be swept out, as well as lows that haven't been swept out as well. So we actually have an example on the current chart on Bitcoin as well. So you can see here we have higher lows being made that are yet to be swept out. So that's like a liquidity target that we can look at shortly once we see a rejection of the price. And the same thing with the lower highs right here. So you can see price is currently pushing upwards after hunting the lows yesterday on CPI. So we can reasonably expect that price will push upwards to take out the trendline traders here. Right, so that's the gist of identifying liquidity. So now we'll look at premium discount and the arrays of the premium discount. We use those as entry points and to further analyze the price in terms of what it will do after sweeping liquidity. So it's a pretty straightforward concept, premium discount. Right, you draw a Fibonacci retracement from the range highs to the range lows, and the 50% point is what we're looking at. So above 50% we consider to be the premium range, and we look for short setups as they have a higher risk to reward than long setups. And opposite way around for discount. Right below the 50% retracement here, we look for long setups. Right, so first PD array, we look at fair value gap, pretty well known already. So it's pretty much inefficiencies in the price when there is a sort of impulsive move towards either direction. It's a 3 candle pattern, so you have to look at 3 candles. So the candle, you identify the candle with the impulsive move, leaving the inefficiency, and then you look at the candle previously and candle afterwards. You mark out the top of the wick of the previous candle, and then the bottom of the wick of the subsequent candle. This zone here is the fair value gap. So to understand it intuitively, just sort of imagine like drawing using a crayon to draw a line across a piece of paper, like really quickly. In real life, you'll leave like some gaps behind, and you have to go back and sort of fill in those gaps. It's kind of like the same concept here with the fair value gaps. It's a way to rebalance the price, and for market makers to go back and fill in the positions that have been left after an impulsive move, where like they're filling the sort of buy and sell orders with extreme speed. Right, so this is a bullish fair value gap. That means we expect once price retraces to this fair value gap, we expect it to act as a sort of support level. And then same thing with a bearish fair value gap. And in fact, we're kind of like seeing this play out right now with this fair value gap right here. Right, so we have here the bearish fair value gap. We have an impulsive move down, and then we mark the bottom of the wick of the previous candle, top of the wick of the subsequent candle, and this zone in between is the fair value gap. And we expect it to act as a resistance zone. Right, and we know that this is a relatively significant level because this zone overlaps on multiple time frames. So you can see 15 minutes right here also exists on the 30 minutes, and as well as the 1 hour and 4 hour time frame. So with this sort of overlap, we do expect this fair value gap to give a reaction, and we can see it has played out a little bit on this initial rejection here just a few hours ago. Alright, so how exactly do we use fair value gaps for trade entries? Right, so I sort of discussed like fair value gaps being used as a tool for chart analysis. We can also use it as a way for trade entries. So consider the trade setup here. Have a sweep of the sell side liquidity, followed by an expansion upwards that breaks the structure, right? Displaces upwards. So using the concept of the fair value gap, we can expect market makers to go back and rebalance the price. And we have the 15-minute fair value gap right here that can be used as the entry point. And then we put the stop loss below the previous sell side liquidity. And you can see here that the fair value gap did give a strong reaction of the price and allowed expansion upwards. Right, and also a thing to note, I just talked about like break of structure and displacement. Want to also mention like how to differentiate a true breakout from a liquidity sweep. So you can see two contrasting examples here. We have relative equal highs buy side liquidity, and price broke through with a lot of strength. Right, so if we're shorting based on a liquidity sweep idea, obviously it would be stopped out very quickly because it was not a liquidity sweep, but an actual breakout. So the key point to sort of contrast between a sweep and a breakout is displacement. Right? Displacement refers to when price breaks through a resistance level and leaves behind a fair value gap. Right, that's it. So displacement is a fair value gap left behind after a break of a swing high or swing low. In contrast here, we have swing high resting liquidity, price wicked above and closed below, right, with a bearish hammer candle and moved downwards. So you can see here there is no displacement left behind by this attempt to break out. There is no fair value gap, there's no momentum or any strength upon a touch of this level. So we classify this as a liquidity sweep and not a breakout. Right, so that's another way to use fair value gaps. One, just a tool to help you like identify whether ongoing price action is a breakout or a liquidity sweep. Right, we can look at some examples recently on Bitcoin. Sweep of the highs, wicked above, closed below, no fair value gap, candle closed as a bearish red candle, so no displacement here. Swing high here, resting liquidity, breakthrough, candle closed above, fair value gap left behind. Alright, so that is displacement, and we consider that to be a true breakout. I should probably open up Discord and see if there's any questions. So if you have any questions, just feel free to ping me in the main chat. I'll also be looking at the Twitch chat periodically. Alright, so just to quickly recap for anyone who recently just joined the stream, we looked at the concept of liquidity, as in places where retail traders will be placing their stop losses, and we identified those as areas of swing highs and swing lows, as well as range lows and range highs, as well as establishment of a support or resistance from equal highs or equal lows, and finally through trend lines. And pretty much we just need to think in the perspective of a retail trader and think about where they would most likely place their stop losses, and that's where we mark out our buy side and sell side liquidity. Moving on to order blocks. Order blocks is levels of previous institutional orders, which resulted in a significant movement in price. Some people call it demand and supply zones. And compared to static supports and resistance levels, they're more likely to give a reaction because institutional traders use those levels as their point of interest. So specifically, the order block is just the candle that closed the opposite color immediately before an impulsive move. So look here, we have a very strong move to the upside, and then we have a red candle that closed before this impulsive move. So this level is the order block. You can see the price wicked down to this order block and then bounced very strongly towards the upside for continuation. Same thing here, right? We have significant expansion upwards. We have the order block here, which is the red candle closed before the impulse move. And you can see that price established that level as support and gave a strong reaction. Right, so bullish order block, support, bearish order block, resistance. Let's look at a few bearish examples. So impulse move to the downside. We have a green candle close before the move. So that is the order block. And you can see that acting as a true support, not support, true resistance level. And also understand that order blocks don't only appear at like extreme levels of the range. It's not necessarily in the top range or bottom range. Order blocks can in fact appear in the middle of the trend. Right, so this level can be an order block as well, and we can look at a few examples. Right, so the way to identify order blocks that occur within a trending move and not at a range high or low is just to look for the opposite color of the trend. Right, so if it's an uptrend, look for a red candle close right before an impulsive move. So you can see here, this is a bullish order block. It's a red candle that closed before a large move to the upside. And this occurred within the middle of the range. And you can see that it was respected by an initial bounce of the price once it reached this order block. Yeah, a few things for extra precision and also to note in terms of higher probability order blocks. So for a bullish order block, draw it from the top of the candle body to the bottom of the wick. Right, so this bullish order block here, top of the body to the bottom of the wick. And the other way around for bearish order blocks. Right, so bottom of the candle body to the top of the wick. If it's a low probability order block, as in there is a large wick on either side, draw the order block based on the bottom of the wick to the top of the wick, as in like right below the candle body. And a few things to understand in terms of higher probability order blocks. Look for large candle bodies and small wicks. If there's accumulation occurring before the impulse move, that makes it a stronger level. So for instance, here we have accumulation with a bullish order block, and you can see this level has held up strongly multiple times. Okay, so accumulation means higher probability order block. If there was a liquidity sweep right before the order block is formed, that also makes it high probability because that sort of confirms the footprint of a market maker. And if there's like no pool of liquidity like very close to that level, also increases the probability, because the market maker won't have like a very close target to hunt in terms of looking for liquidity. Breaker blocks is just previous order blocks that have been broken and has flipped from either support to resistance or resistance to support. We have this example here of a bearish order block that was broken through and has been re-established as a support level. You can see that when the price wicked downwards to that breaker block, it gave a reaction and a bounce. So that means it is a new support level that was previously resistance. And the last PD array we're looking at is the optimal trade entry Fibonacci's. So the settings just be 1, 0, 0.79, 0.705, 0.618, 0.5, and then the extension levels be negative 0.27 and negative 0.62. So the optimal trade entry refers to this zone here between the 62% retracement to the 79% retracement. And pretty much we expect that when price enters into the OTE zone, it should give a reaction. So you draw the OTE fibs based on the swing high and swing low level. So the swing low here and swing high. Right? And you can see that price returned to the OTE level before bouncing upwards. And the main way that I actually use the OTE fibs is in confluence with other PD arrays. So if like a fair value gap aligns with the OTE zone, then that establishes the level as a stronger point of interest, pretty much. So this leads me to sort of like discuss which PD arrays to use. Right, so what I mean by that is sometimes there are like multiple fair value gaps left behind, right? Like this, by this strong move to the upside, multiple fair value gaps here, here, and here. So obviously not every single fair value gap will give a significant reaction. So we need to consider ones are more likely to give a reaction. Right, so if it aligns with like something else, like a breaker block or a the OT fib zones, then that gives that level as a stronger probability level. So you can see here, there's a fair value gap here, breaker block, right? It was previously a bearish order block that was breaking through and now flipped from resistance to support, and that aligns with the fair value gap. So based on that, we anticipate that price will react from this level rather than this order block here, because there are multiple confluences at this point of interest. So yeah, quite a lot that we just went through, but pretty much if you put this into practice, sort of like mark up your charts and see how it plays out, that's like sort of the best way to better understand these concepts and make more effective use of it. And last thing I wanted to discuss is understanding market structure. It's pretty much just another way of confirming a change in direction. Right, so obviously like it'll be kind of risky just lying straight from a PD array without like a shift in the trend. So you can see from this example here, there's an order block and then there's a very strong downtrend. So if you just long straight from the order block, would have been stopped out. So the purpose of understanding market structure is to identify a potential shift in the trend and give extra confirmation of the trade. Right, so market structure is pretty much identifying higher highs and higher lows for a bullish structure, and lower lows and lower highs for a bearish structure. And in this case here, you can see there was like previous uptrend, right? And then it formed a lower high, broke below the previous high low, and then formed a lower low. So you can see this is a break of structure and indicates a potential shift in the trend. And pretty much how you make use of that is you wait for a break of structure, and then you look for a new PD array to mark your entry, and that way you can have a tighter stop loss, better risk to reward, and yeah, pretty much less likely to be stopped up. Makes your trade a higher probability trade. Just real quick, just noticed that some pretty strong movements on Bitcoin. Are you looking at this chart, Ahmed? Alright, so I think you're muted by the way. So we had an attempt to break out, but we just had this like very strong red candle. As you can see, like no really strong or actual breakouts, just the sweep of liquidity on either side. So just now we took out some relative equal lows, and then previously the pump took out the swing high level. Alright, so next thing, just wanted to discuss a few of our previous trades to sort of like put all of these concepts into practice. First trade I wanted to look at is Ahmed's Bitcoin shorts from 30th June, right here. Do you want to walk us through your trade setup, Ahmed? Right, I'll just come back to this in a second, once Ahmed is back. Right, so this is a Bitcoin long from 29th of June, yielded 2.5 risk to reward, and the setup here is a sweep of sell side liquidity, and then we had a 15-minute candle close above a break of structure level, as in like candle closure above a swing high.
Sure. Am I audible to everyone?
Oh, there you go. Yeah, do you want to just discuss the short that you took? Like, that played out pretty quickly. I think you need to unmute yourself on Discord, Ahmed. Question chat, if I sub with Prime, do I have access to some sort of promo? Yeah, we've just recently started to stream again on this channel, so nothing that I know of so far. Right, so yeah, sorry about that. So I'll just
Sure.
have Ahmed
Am I
discuss.
audible to everyone now?
Yeah, sure, go ahead.
Okay, so we're talking about, first of all, thank you for signing me up, Jordies. Apart from that, if we look into the chart we are talking about, was pretty much on the same concepts that you described earlier. Let me give you a quick review about it. Okay, so the previous short was basically, could you tell me the date on which it was? Because I kind of like remove the setups when I let them play.
Yep.
Okay, so it was on 30th of June. Let me see. Okay, so this was the trade actually we were looking for. If you see here, these are the pretty messed up levels marked, but this pretty much makes sense to me. This was the previous range high liquidity that we had. If you see here now on the daily, that was the previous range liquidity that we had. This one right here. If we zoom here, this was the liquidity that we swept. So apparently on the lower time frame, this was the area of my interest mark. And if you could see here, price actually went into the ladder case, which is a prior concept or the prior key feature that I look for the price to reject at certain levels. So if we look here, uh, okay, yeah. So where were we? Okay, on 30th June. Okay, so if we look here, price apparently went to this is the ladder pattern that we were discussing 2 days back. The price actually went in here. It's like it goes up, take the first high, and then it retraces a little. The retracement is actually 70% or 75% due to the first wick, and then it makes a lower high, and then actually it gets a sell off here. The reason why it does the retracement is actually it tries to bring the FOMO in, or it tries to kick in the early buys or early sells, and then price actually sell off. So if we see here, and if you see the certain pattern, we actually did the same over here. We took out the previous range high, price went into the make higher high, trying to break the structure, but eventually it was not the volume structure we were looking for. It came down, retraced a little. If we see here, it like the fibs could actually help with it. If we have a fib lowered here and we actually pull back from the zero point 0.7 or the 0.68, these are the fibs I actually use. The one OT fibs that Jode has also explained are quite reasonable, helpful in this. But if you see here, like 0.618 and 0.702 were the fibs that actually give a quite good reaction. And the price made a higher high. It went low, and then it retraced the 70% of the wick that it created, and it rejected from the previous high. That was a quick sell off, and it took like I guess 3 minutes for the trade to play out, and it was a pretty decent RR, I would say.
Yep. Thanks, Ahmed. So yeah, that was definitely a bang trade. I actually took this trade for phase 2 of my evaluation, and yeah, let me pass pretty quickly. Played out very quickly. You can see like it dumped straight down. So thanks for your explanation. So looking at the next trade, yep. So it's the Bitcoin long 29th of June, and it's pretty simple setup of sweeping a low from the 4-hour time frame, followed by a 15-minute break of structure, and resting liquidity above as our next target. Next trade is a long on Ren. This is actually Ahmed's setup. So do you want to sort of walk us through this setup as well, Ahmed?
Sure.